Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, February 7th, 2025. What I'm going to do in this video is start out with the equity markets, talk a little bit about the economy, which is, of course, fundamental analysis. When I look at the charts, that's technical analysis. And when we look at other things like employment and all that, earnings, those are fundamental analysis. And I do marry both together. You know, my background, I'm a business major, former stockbroker, financial advisor, so I have that background too. I spend most of the time talking about technical analysis on the site because, given the two, nobody, and I mean nobody trades, swing trades, actively trades off fundamentals. Fundamentals take often years to play out. Warren Buffett invests via fundamentals, reading balance sheets, looking at future earning growth, and we'll sit in a position even if it goes underwater with a holding period measured in years, not days or weeks. But again, to marry them together and to look at the bigger picture, because I always say you have to pick a team. You know, I've heard people say, "Oh, just trade the charts in front of you." You have to have a bias. Some say the biases are bad for trading because otherwise you suffer from paralysis by analysis. At any given time, you give me a chart, I can pretty much with any chart at any time make a bullish case, they'll go long, or a bearish case. That's it. So now, thing is, don't get married. Be open to other views. Constantly, what I do constantly keep reviewing the charts. Did you miss something? Or more importantly, did something change? Maybe the charts were indicating something was bullish and going to rally, or vice versa, and then things changed, whether it was fundamental or technical catalyst. So let's just talk about fundamentals real quick, and then we'll get to the charts, key levels to watch. This is just a 1 minute chart of QQQ right here. These are the daybreak lines. I have them very subtle here, but so this was this morning's open. There was yesterday. We opened up, had a trend day, moved higher throughout the day, closed up. This morning, little rally out of the gate, and then at 10 a.m. We got checked with the employment report, and it's a pretty decent down day. Again, this stuff is all technically induced. I can get to the charts here in a second. Where's NQ? That's NG. NQ. Gosh, I have so many charts here. This is one of them. Nope. This one here. Again, these things, I've been doing this a long time, and very often, not always, but usually, a fundamental catalyst, such as the employment report, is the technical trigger for a breakdown. This is my go-to swing trading time frame. Is if you follow me for any period of time, the hourly charts are pretty much my primary swing trading time frame, and I have a pretty simple but pretty effective strategy of looking for divergent lows, divergent highs, and then wait for buy or sell signals, either pull back to support. It's an objective time to go long, especially with a divergent low. You get the rallies, you go up, and then all trends come to an end. You get a divergent high, and then you get a breakdown sell signal, and with a divergent low, you get a rally up, down. You get it. So this was a divergent low there. I got to borrow that commentary because it's not there, but the lines are drawn, so you see divergent low, high. Simple stuff, right? And this is all within a trading range, as I've talked about. We've been in a trading range. You can see this was the last divergent high. Boom, big drop there. By the way, that was I mentioned these deep seek gaps. That was the deep seek gap right there. Futures open Sunday evening, gap down, and they tried to pop it. And this is why you hear quite often when I see a resistance level that should, quote unquote, should cap a rally. Let's say if I'm short, then I will set my stop not right above that resistance level. You almost have to bank on the powers that be to run that. They know where the stops are. So when a lot of people see that, they put their stop right here. What do? They get clipped. The big trading desks, they run it up, pump it up, grab your share, stop you out, and then they turn around and go short. And then they do that. And, again, not everybody, but that's just how it's evolved over the years. So any level where a lot of people are likely to have stops are likely to get hit in this market in this day and age due to algorithmic trading programs and high frequency trading and all that other stuff out there. So, but keep it simple. Keep it simple. This was a bearish rising wedge with a divergent high, i.e. negative divergence. This was the most recent bearish rising wedge. I had a smaller uptrend line the other day that was broken back tested, but that was it on the 60 or 15 minute? Yeah, it was 60. Either way, this set up with an even better trend line. Why is it better? Well, more reactions. The more reactions a trend line has, the better defined it is, the more valid it is. Why? Because more eyes are likely to see it. 3 reactions to me is minimum to make a trend line, because you can connect any 2 points at random. So that's not a trend line. I'll draw them that way sometimes as a potential trend line, waiting and watching for that third confirming reaction. But once you get additional, this one had at least 4 or 5 there and then broke today. So that is a sell signal. It follows 3 things, by the way. So that in itself is a sell signal. The breakdown right here, this bearish rising wedge that I just highlighted. So that's, let's just say, objective short entry number 1. Number 2 was that deep seek gap that I highlighted. Remember, NQ was testing the top of it yesterday when I highlighted it. ES was testing the bottom of it. And then we had 2 failed breakout attempts. And as I often say, fewer things in technical analysis or trading are more bearish than a failed breakout. The only thing more bearish than a rally up to resistance like this and then a rejection off the resistance is exactly those little pops that are false breakouts. Why? Because when you pop the levels, when you take the resistance level out, new longs pile in. They take that trade, they see a breakout, and then short sellers get stopped out. They see their stops are too tight. They're trying to manage loss, and they get stopped out. So that has 2 dynamics. Now, the short sellers have been purged, and that's what creates the room for bigger drops. When you have a lot of short interest in a stock, you have short sellers covering on the way down, taking profits. So you want to be a lone wolf when you're shorting. It's ideally, you don't want to short a crowded trade. You get stuck in short squeezes and stocks, every dip going down gets bought because short sellers are taking profits. Then the other thing too is the longs that jump in on the breakout. Well, they've set their stops a little bit below the breakout in case it fails. And so, boom, their stops are being hit, which means they're selling, and that causes these quick downs. And there it is. So we had, the bearish rising wedge breakdown. We had a rejection. This is a new downtrend line that's formed. You can see I've added to my charts recently. You have lots, the highs right there. And so far, this is where they keep selling NQ. And also another false break above the deep seek gap right there. So now... I color-coded this, and I will say that I am, open to anything and very, very much open to the possibility they may pop this trading range. And if they do, even though this is the all-time highs and that is resistance, you can see a lot of reactions here, a couple here. So if you see this trend line clearly get taken out, particularly today's high, then that last week's high right there, these highs, that's going to be 1, 2, 3 reaction highs taken out, and it's going to help formulate or make clear that we have a new uptrend line if we get a new high here, because you have lower lows, and then you'll have at that point again lower highs, and it's probably going to send us to new highs. So as I mentioned, it will not change anything on the monthly, weekly, daily, or even 60-minute charts. Let me toggle back to QQQ real quick. Just want to show you the knockdown on, and then we'll get to the charts in a second, the employment data. All right, so this is what I've been highlighting for everyone. I added these the lines right there. That's the green line. It's about 534 in QQQ. The red line, I believe that aligns with what I have on NQ. And so this is that multi-month trading range. Remember, we've been in this trading range since the beginning of November of last year, and that's where all the trades have gone. So again, I want to reiterate, if you're frustrated right now, because if you're mainly trading or only trading the stock market, you're having a field day if you're an active trader and you're nimble at this stuff. You're extremely frustrated if you're a long-term or typical swing or trend trader or an investor, because the market's gone absolutely nowhere now for months. And again, if we pop the highs, I maintain I'm very much open to that possibility because we're so close to it. Anytime soon, as you can see, this yellow line is simply an extension of the divergence. And again, if it happens soon, like as in next week, let's say, it will be guaranteed. If it has to happen relatively soon and it needs to be marginal with a reversal, If we go up too much, you take out the divergences, you start taking out the old highs. So that doesn't change, and I would put very high odds that a breakout would fail. Now, if we don't go up, remember I did the analogy, earlier this week, of the uncanny similarity between the technical posture and price action in the market now over the last couple of weeks, couple of months here, and then that at the end of 2021, right before the 2022 bear market. Again, it's almost too similar. However, as I pointed out then, the S&P went on to make new highs into the end of 2021, right up to the start of 2022, whereas the NASDAQ 100 peaked a couple months before that. The NASDAQ peaked, I believe it was back in November back then. And that's what we have now. So while this is certainly a possibility and one that I would put good odds it's not going to go very far, back then it looked like we'd get that breakout, could get that breakout, and we didn't. And so the sell signals that we had earlier stuck. This was a sell signal, a breakdown and back test of the primary uptrend line off the August 5th lows. And now, remember, I started the video showing you we just had a breakdown on the futures on that 60-minute chart following the most recent divergent high. So that's that. Let's talk fundamentals real quick. Let's go over here. Okay, on the site, I talk about this often. Again, if there's new folks to the site, on right side of the chart.com, on the top menu, go to resources, and then under there, go to tools of the trade. I didn't have it queued up now, and then you'll see both an earnings calendar, very important lately in the earnings season. Know which securities you have that are scheduled to report, because you go into earnings holding a stock long or short, you have a big risk of a gap. Especially, and I always say, do your due diligence, know your security. Some stocks have a history of really big gaps. Netflix, things like that, 10+% easy all the time. And so you know that you're taking a big risk. Obviously, you can help mitigate that risk but let's not talk about hedging, but by looking at the charts, and if the chart's clearly bullish or bearish, that's usually the way the earnings gap or move is going to go out of earnings. Then you have some stocks, they do a tremendous job of managing earnings. They're not as volatile, so they don't have much of a history. So again, if you're going into one of those stocks, don't trade a stock if you don't know its history. And it's easy to just look at the chart. You can go back. They report every quarter, every 3 months, and just, again, know the history of that stock. And you have a link to the earnings calendar on the site. And there's plenty others online. This is the other thing that I check all the time, the economic calendar. Again, that's right under tools of the trade. And this was today. So what happened? This is we had the employment report, non-farm payrolls. Consensus was for 168 new jobs. They only created 143. So that's why the market tanked at 10 a.m. Back in the day, this was actually, the market would rally on that, expecting the Fed to cut rates. But we all know the Fed has cowed down, and at least for the time being, and they're not as dovish as they've been throughout almost for decades now, due to that nasty little thing that we call inflation. So that's that. That's the catalyst, again, the fundamental catalyst that triggered the technical breakdown of that 60-minute bearish rising wedge pattern. Private payrolls, they were expecting 140,000 new jobs, only got 111. Manufacturing payrolls, expecting 5,000, only got 3,000. That's 60%, or 40% below what they were expecting. So forth and so on. So you can read these, watch these, be aware of it if you're trading anything related to the economy, which i.e. the major stock indexes and other things like that. So now let's change gears into look at this. So I've covered this quite often in the past. There's quite a few sites. Macrotrends.net is one of my favorites for fundamental charts, economic charts. This is the national unemployment rate. And this is what I covered all into, heading into last year, especially once the turn came. And again, guys, this is to me probably the single most important chart that I believe will make my expectation of a major bear market and a recession in 2025. I thought we might get it in later 2024. It didn't come, and I'll show you why. But of this, and again, if you know economics, basic economics, you know that the single most important thing for the economy, bar none, not even a close second, is the jobs market. Because consumer spending accounts for over 2/3, about 70% of GDP. So all this crazy wasteful spending you hear about, and you know the government does, they can stimulate, they can put in, do what they want, but they don't. The government spending, as much as it is in dollar terms, it doesn't move the needle. You, me, everyone listening to my voice, we move the needle. Consumer spending, again, that's just a fact. It accounts for over 2/3. And we know that when people start losing their jobs, that correlation is immutable. You're going to see when a recession hits. Okay, so hopefully you're with me on that. That's not my opinion, that's fact. But what I've showed you here, this is as far back as I can go on this chart, I believe, all years. And this is nearly an immutable development, if you will, or precursor to a recession. So these shaded lines that you see up here, these are all the shaded lines, are all the recessions going back into the pre-1950s. So we're going back into the 40s here. And what happens is we have a recession, unemployment spikes. Then starts to fall, you have an expansion. This is the business cycle. Contractions, expansions, right? And then at some point, and again, with either little to zero deviation or exceptions, when everything is hunky-dory, especially, and you want to look at this, you probably want to go to more recent years, but because back then you had a little bit lower lows, the way they measured things, they made changes to how they gauge unemployment. We've had a lot more immigration in recent years, undocumented. So things, it's not there's no absolute floor, but you can see this is roughly right here. This line is roughly the floor going back for over 70 years, right? 3/4 of a century right here. And then you can see before the recessions, unemployment, because that's what just about every single economist, what they're hanging their hat on to make us strong, well, maybe it won't be as strong, but we'll still have positive growth, no recession 2025, is because the jobs market's strong. Well, the job market, two things happens. Number one, every time before a recession, you can see there is a turn. And you can also, as I've pointed out, when employment bottoms, it never stays there. It's always a V. And it comes down to record low levels, which is around that range I showed you, right about where we are. And then it turns, again, with zero variability. You can see that the turn comes first, then comes the recession. And the other thing is, once the turn comes, that's it. And then it starts to accelerate into once the recession becomes apparent. So you can study this chart. Again, just look at all of these troughs in the employment. Again, especially down around these levels. And you can see the turn. And you can also, if you want to play around and you have the time to do it, you can track it in percentage terms. There seems to be a level. And this is clearly at least that level right here, what we have right now, that is more than just a little aberration or a blip. In other words, you get these little zigs and zags down the way, but they're tiny. Once you can clearly see, again, if you see this the way I see it, you clearly see a turn, which is measured by about that much. That's it. And you just don't see it around the bottom, and then a little blip, and you keep going. So the turn is in right there, and this continues to rise. And again, it is a timing indicator somewhat, but the timing is it bottoms first. So if you're wondering, well, Randy, you were pointing this out the end of last year. Yeah, because it turns and then it goes up, then the recession follows. And by the time you read about it in the papers, by the time the NBER declares a recession, half the time you already missed it. It's over. Because in recent years, the Feds come in so aggressively, and this was the last recession right here. That was COVID. And if you blinked, you missed it. But it was technically a recession, at least declared by the NBER. They get use subjective measures. It's not even quantifiable. But the old standard definition, not the NBER's, is 2/4 of contracting GDP. And anyway, so that's it. So I wanted to point that out, and we'll just a trend to watch. And again, from looking at this historically, from record low levels where unemployment usually bottoms, I struggle to see where we've had this much of a turn and it's only been a blip with another leg down, or we stay down at this level for a period of while. Again, look at these bottoms. They're all V bottoms. This is the closest thing to a non-V bottom, but that was a smaller blip there. Then the turn came. So anyways, that's that. I find that very compelling. And could it be different this time? Sure, but be careful. Those are dangerous words in the stock market. And again, guys, not an exact timing indicator, but kind of a heads up indicator and something that usually occurs. I don't know. You'd have to measure it out 6 months or so. And again, these are just where the official marks for the recession began, but you can see what happened there. So, all right, let's move away from that. Let's talk charts again. The other day, I mentioned I was going to get to the VIX charts. I showed you where I posted the chart to the VIX in the under the comments section, and I realize now I didn't get to that in the video. So here it is. Somebody asked me my thoughts. Was it yesterday or the day before? Randy, what are your thoughts on the VIX? Is it still a buy? I said absolutely. I believe it is. VIXY is the ETN that I've been sharing as a trade idea. I personally like the VIX futures, but many don't trade futures. And this is it. This is also long-term support here. We've had a divergent low. We had a nice pop. And as I mentioned recently, I even shared this as an official trade idea. We're right about where we started when I did. And this is the downtrend line that if and when popped should send the VIX higher. You can see some near-term targets. And that was it. So we had a trade idea on the VIX back here. Popped it. We had one back here. We caught that. And that was right then. Back then, it split. So my targets are gone now. They were on the daily chart before. But these are also the longer term targets that I gave you recently. So there's that downtrend line. And that's it. So the VIX looks good. And just, in that reply that I made the other day, I said, even if it makes a new low, that's fine, because you can see right now we have this. This is really a flat line on the bottom, so that makes that a descending triangle pattern. So a breakout above that's bullish. And if we go like this, a little bit down, a little bit longer, let's just say that the market, QQQ and SPY, they make new highs in the next few weeks or so here, then you'll probably see the VIX drift a little lower. But the RR, and I evaluate almost every trade on an RR, risk to reward perspective. In other words, you want to make risk $1 to make 2 or 3 or 4, depending. And the higher the RR goes, the risk reward ratio, the better the trade. Well, the upside potential on the VIX, again, you got to have the market break down. This, as I said, if the market goes to new highs, we're going to drift lower, but not a lot lower. Low enough you probably won't want to ride it out, especially these ETNs. They just decay over time. You lose money over time. Futures are a little better if you can do that. But, my third target there is 167%. VIX isn't going to drop 160, not in the next few months here. You can look at, again, the spot VIX and all that. So the downside is limited because we're at support. And the VIX is also a range-bound little sucker. When you look at the spot VIX, again, don't look at VIXY. It's a derivative, an ETN or ETF that tracks the VIX, the spot VIX. But when you look at the VIX itself, this is it. I'm rolling back as long as I can roll back here on a weekly chart. And this is where previous bear markets ended. This is 90s right here. There's 2000, the dot-com bubble. That's where bear markets used to end. Over time, and I've pointed this out, the VIX has different low-end ranges. And right there was really, that was support back then in the late 90s, early 2000s. Then we entered a new era of low volatility back here. And since then, this has been the low end of the range, which we just kissed recently, that yellow line right there. We had a few very brief spikes down below, and that is the maximum, and at least in recent years. Again, there's no set bound other than 0, but it's never going to go to 0. You can just see this is the VIX. And again, we're coming off very big divergent low, just like we have those big negative divergences on the market. So if you for a second there, I've wondered why I have not abandoned, only gotten my convictions gotten stronger on the bear market that's coming, and that it's going to be a big one. This has a lot to do with it. And again, it's just like turning the stock market upside down. Big negative divergences all the way from the monthly, weekly, daily time frames, just like you have on the long-term charts. Big positive divergence here. You did at that low, and the VIX has already started to wake up. Like it usually does, wake up. This was 2007, if you guys were around. The stock market peaked in October of '07 right here. So you had that divergent low, you had that shot across the bow, which happened in the summer of '07, before the bear market started. The stock market kept going up. And so you get that initial shot across the bow after the divergent low. Then right here, this is right there, this is the line where the bear market started. And it ended in '09, March of '09, but the VIX peaked first, and which is often the case. And this is where that bear market ended. The VIX marked that. It was the NASDAQ actually bottom in late '08 too, right here. And then this is where COVID ended. So that's where bear markets, since for the last 20 plus years, 30 years, have all ended. And this is where corrections end right here. And that's all that 2022 did, got us back there. So there's your update on the VIX. And my VIX futures chart, it's now, I'm on a 6-month chart, so it just cut off. There is, if you follow this up to the, here, there's a reaction high that it comes off of that line. So you have 1, 2, 3, 4, and that's it. So like I said, the VIX, once it breaks this trend line, especially clears some of these previous reaction highs, and this right here will probably coincide when it breaks that. The VIX is going to let loose, I believe. We're talking triple-digit returns from this level. That's going to be a big breakout level. And that will probably, my guess, roughly coincide with a break, if we get it, of those red and green lines. Remember, this is a simple, NQ. This is a 3-month chart right here, 60-minute candles. There's my bottom of the range. Red line means lights out for the market. Green line means probably go to new highs and then fail. And so far, we just had the first sell signal here on the 60-minute chart in a while. So we probably are not going to see those highs. Like I said, I'm open to it, but I'm not betting that right now. There's enough evidence to say the top is likely in. We still have the big bearish engulfing candles on the weekly chart of QQQ, very much intact. As I mentioned back here, is a long-term swing / trend short trade. Then we broke the uptrend line off the August 5th lows right there. This is a weekly chart. And see, if you look at the weekly chart, 500's about 500 right there on QQQ. It should do the trick. It's a previous all-time high right there. We had that correction there. We broke down here. We've been bouncing on that level, and I believe that's going to roughly correlate with the red line I gave you on the 60-minute charts. All right, we'll just let's take a quick look at the the Mag 7, 8, 9, 10, whatever you want to call them now. Apple. I'm just going to kind of cover this briefly and reiterate what I'm looking for and what's going to vastly increase the odds that we're going to start a deeper downtrend anytime soon, or not. And that is Apple. Apple recently, I'm on a weekly chart. As I often tell you, I have the 40 period, which are the 40-week moving average. Same exact thing as a 200-day moving average if you're on a daily chart. So on your weekly chart, set it to a 40 period because there's 5 days in a week. So that makes it the same as a 200-day moving average. They bought it there. Apple breakdown sell signal 1 here, as I highlighted back then. Sell signal 2 on a break of the trend line off the April lows. And then boom, hits support right there. And the 200-day moving averages bounce back tested. And so that's it. So Apple right now, as far as the next sell signals I'm looking for, we do not have a check mark, but we will, especially on a weekly close below these 40-week moving averages. So I'm waiting for that. We don't have it yet. We're still above them. And you cannot get too bearish or too short when you have, especially the majority, almost all of the top stocks that matter, that move the whole market above their 200s. So that's something I continue to watch for. I continue to expect to see a breakdown in the coming weeks to months, But sometimes they buy it. Well, they tend to buy them in a bull trend, and so that's it. So when we get it, we get it. And not before then. Microsoft, as I talked about, has just been hugging the 200s. It won't go lower because the rest of the mag 7, 8, 9, whatever you want to call them, are all above there. But it is below there. So that is a check mark, but I need 3, 4, or 5 check marks on the top components to say with a high degree of confidence that we've broken down and given up the 200s. And of course, you want to see QQQ and SPY below their 200s as well, ultimately. But that's it. So there's Microsoft. These are just my targets for in the next coming years here. There's that primary super secular bull market off the 2009 lows and T3. So that's where arrow breaks, kind of, or line breaks, show how to play out. And again, it's not going to do this until Apple, Nvidia, Amazon, Alphabet, they all break down too. There's just super high correlation between these guys. Nvidia has broken the primary uptrend line, as I talked months ago, with a back test and a rejection, moving lower, and it's been testing for the last 2 weeks. Especially, you want to, again, longer term, you want to look at the weekly charts. And so we're no matter what happens today, we'll close the week on or around these 200s again. You want to see them clearly taken out. So whether it's next week or 6 months from now, you want to see a big red candle, a solid close down below those blue and red lines, which are the 200 simple and exponential moving average. Where right now we're right on the 200 simple. Amazon has a beautiful uptrend line. We've got most of these stocks are now out of the way. We're just waiting on Nvidia. They kind of are an outlier. All the other big Mag 7 or whatever reported. And this is, again, big negative divergence, big bearish rising wedge, but it's above trend. So Amazon has a long way to go, relatively, to get to the 200 days. They're all the way down here, which I'll measure for you. But first things first, a break of this trend line is going to be a very nice, clean sell signal, in my opinion, because it's a nice, well-defined trend line. A lot of clean reactions. And so we're right on the line now. We'll see how this week closes. We'll see how next week closes. And you might want to set a price alert on that. Here's how it looks on the daily chart. Daily chart, you can take that trend line. It comes off the August 5th lows like so many others. That was a key low. There's your uptrend line. We're on it right now on the daily chart. And so a little more downside is going to bring us to the first support level there. It's about 218-ish, 217, 218. And then there's a secondary longer term trend line that comes into play. So check mark 1, a break of this trend line. Check mark 2, a break of 217. And so forth and so on. And that'll just, I think, simply a break of this trend line, and especially a break of this support level just below it, will open the door and bring us back to the 200s for a test of the 200s. And that's going to be a drop of another 14% to get down to the 200s on Amazon. Alphabet broke down. This was a valid trend line. If I zoom in tight, I'll show you what it was. You had this uptrend line right here, breakdown, back test, rejection. Then I set up this secondary, what I call BOD, benefit of the doubt trend line, and that they gap down below it on earnings. And there's your 200s right there. And this yellow line is a big level. Come off the January 2023 lows, set a trend line. It's just below the 200s. I would have price alerts on that trend line. So if the 200s go, that trend line's there. Anything beyond that, that's a powerful longer term sell signal. Until then, we're still not too far from highs, but big divergences building tell me that the upside's limited. If we make a new high, it'll still be a divergent high anytime soon. You can just take these lines and extend them. Meta does what Meta does. It's been probably the most resilient of the Mag 7, Mag 8. Divergent high, that's all I can tell you. It continues a big divergence. And it'll get dragged down with the rest of the lot, meaning the other Mag 8 or whatever, if and when they break down and give up their 200s. I don't care how much money Meta's making. It's all about indexing and psychology, and it will go down. It's been, again, one of the strongest. And I did this analogy, too, back to the top in late 2021, where you had there were different leaders back then, and in two different weak ones that first broke the 200-day moving averages. So you have, again, a very similar setup as you did back heading into 2022. Tesla T1 hit. I gave you in recent videos around the end of the year and beginning of this year. Trend line 1 broken, trend line 2. We got very close there, but didn't quite hit it. We just hit it there. And these are the longer term targets I gave you back then. Also on the 60-minute chart, I think it was a mid-December video I highlighted, gave you these, I gave you the sold target then. I added another one since, T2 on the 60-minute chart. And we just hit this today with positive divergence too. If they can step in and buy it here, and if you are bullish and you want to own Tesla, you are at support. You are at the target I gave you from back here. Right before we broke that, actually, in that video, we got that sell signal. We got the secondary sell signal, and we just hit that level. So we're at support with positive, aka bullish divergence. You can go long with a stop there. However, if that breaks, watch for this divergence to get taken out, and then it should be a relatively quick swoon down to T2. Very thin on the volume at price histogram bars. Don't know if you can see them here. Just says most of the trades occurred in this level here. I don't have a freehand tool right here. And this is a thin zone that's likely to get backfilled pretty quick down to T2, about 274 and a quarter. If this level goes, especially if this divergence gets taken out. But as of now, that's what you have there, positive divergence at support. All right, that's it. I don't want to go over each and everything. I'll talk on a couple stocks. I know I watch Pinterest. Pinterest is one of my favorite apps. I am an avid user of Pinterest. I had nice pop after earnings. I hadn't been highlighting this one. I don't believe I had least, but here's an uptrend line it's been trading on. It's in no man's land. It just broke out after above this little resistance level after earnings. But the other one I wanted to highlight, similar. I don't use it. Pinterest I use all the time. I have to say I don't think I've bought anything on Pinterest, but I'm a very visual person. My wife and I are always doing projects on the house. We just put a new pool in, remodeled, dig up, tore out the old pool, put a new one in. We wanted pool ideas, kitchen ideas, bathroom ideas, you name it, and even recipes. Anyway, I love Pinterest. And so I can see it's all about getting the users, and they can monetize. See, they push the ads there, and I don't mind clicking on those. There's a little trend line right there, and it's also just taken out. But let me give you an update on Etsy. I haven't talked about. There's a lot of trade ideas I floated out recently, and I don't update them all if there's not a lot going on. Etsy, I gave you a total of 6 price targets. It broke out. I highlighted breakout there. Reversed just shy of my first target zone, but last update I gave was backtesting. It's been backtesting the primary trend line. Let's see when they report. They report on the 19th. So a constructive chart. If I had to bet, I bet this one goes up unless the stock market is really in a pretty heavy sell-off mode. So in other words, if those red levels break on the indexes, the bottom of the trading ranges on NQ, QQQ, this one will be swimming against the tide. However, it's a very constructive chart. So right now I had to bet, especially if the stock market is holding up. My bet is that this one will probably gap up on earnings, and you have those targets. And again, I'm just updating the trade. It's just still above the back test. But it's also the 200s. I talked about that before. You've got to take out the 200s right here. It's got hit the 200s, rejected, hit the 200s, rejected, hit the 200s, rejected. Reverse just shy, tried to pop them, couldn't do it. So once you pop that level, it should go. Now, remember, they're going to report in a week or so it's going to go into a holding pattern somewhat. Most stocks aren't going to make a big move right before earnings. Everyone's kind of in wait-and-see mode. Just wanted to update that one for you. Other things, treasuries, fine. They're down today. Told you just shorted those. Still got a little more downside left, I believe. What else? That's it. Let me just stop it here, because if I start going into the commodities and the metals and all that, it's going to be one of those hour-long videos. I try to keep it right here where it just hit the 39-minute mark. Remember, when you watch these videos, guys, you can go in the bottom right-hand corner, click on the settings icon, cog, little wheel, and increase the playback speed, whatever you want, 1.25, 1.5, 1.75. You can always slow it back down. Gets you through these videos a lot quicker. And you can also slide along the bottom if your monitor is big enough, and you can see, take the little time slider, and you can see what chart's being discussed. That's another way to kind of skip ahead to what you're looking for. Okie doke. I'll wrap it up here. We'll see how the week closes. Again, where we're at, I don't think we're going to have a lot of insight to where we're going next week. But just to summarize it, we had those breakdowns with the most recent divergent high on the NASDAQ 100 right here on NQ. That is a sell signal. The last time we had a divergent high, you got this drop. The time before that, you got this drop. And the time before that, you got this drop right there, right? So it stands to reason that we can have something along these lines, and that would be in line with the previous drops. And again, that could bring us down to the key support level, and we'll see what happens there. Likewise, if we break above here, I've already explained that. 1, 2, 3 reaction highs will be taken out above 2109, as well as this key reaction high here and that reaction high there. And there's just it's all thin air. It's thin air between that and the new high. And there'll be a lot of short covering and all that. And that's what usually sends you up to test the previous highs. And this market has an MO of punching through, making a marginal new high, and then falling down. However, remember, SPY or the S&P 500 already made that high. And back in late 2021, this is about exactly how the NASDAQ 100 looked. It peaked there, looked like it might run up, but never did. It failed to make a new high, and then that's all she wrote. From there, it fell into well into 2022. Okay, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.